There is a specific kind of silence that precedes institutional panic. It does not sound like alarm. It sounds like careful language. It sounds like measured reassurances delivered in subdued tones by men in suits at podiums. It sounds, if you have studied enough of these moments, exactly like what the Federal Reserve has been communicating for the past 18 months. Gold knows this silence. Gold has heard it before. In the 12 months preceding the collapse of Bear Stearns in March 2008, gold rose 30%. In the 6 months before Lehman Brothers filed for bankruptcy, it was already pricing something the equity market had not yet acknowledged. In 2011, as Europe's sovereign debt crisis threatened to fracture the euro project entirely, gold reached what was then an all-time high, while institutional voices were still insisting that the situation was manageable. And right now, in this moment, gold is doing something it has never done before, breaking into price territory with a persistence and a sovereign demand profile that does not resemble any of those previous episodes, because what is happening now is not a crisis inside the system. It is a crisis of the system itself. Let me give you the numbers that frame what we are about to discuss. The Federal Reserve has moved from near zero interest rates to the highest policy rate in over 2 decades. A tightening cycle executed at the fastest pace since the Volcker era of the early 1980s. Simultaneously, the United States government is carrying a debt load that Paul Volcker never faced. $30+ trillion, generating interest payments that now exceed the entire defense budget. 3 significant American banks failed in a matter of weeks in the spring of 2023, representing the second and third largest bank failures in American history, and the Federal Reserve responded not by tightening further, but by creating an entirely new emergency lending facility overnight. Global central banks purchased gold at a pace not seen in half a century. And the Federal Reserve's own internal research division published analysis acknowledging that the bank supervision failures it was examining were systemic in nature. Most people looked at these events and saw a series of unrelated stories: a banking story, an inflation story, a gold story, a rate story. They are not separate stories. They are the same story, told through different instruments, and the version gold is telling is the most honest of all of them. Stay with me through the next 20 minutes because I am going to give you 3 things that almost no one is connecting with sufficient clarity. First, why the 2023 banking crisis was not resolved. It was deferred, and what that deferral means for the Federal Reserve's ability to continue pretending it controls the situation. Second, why this moment is structurally larger than 2008, not smaller, and why the comparison most analysts reach for actually obscures the more dangerous dynamic underneath. Third, what gold's current behavior, the sustained institutional buying, the sovereign accumulation, the persistence of the price at levels that would have seemed extraordinary even 3 years ago, is actually telling us about where we are in the long cycle and what historically happens next when gold moves like this. I have been studying credit cycles, monetary transitions, and systemic institutional stress for longer than most commentators have been in finance. I watched 2008 unfold not with surprise but with recognition. The recognition of a pattern I had seen in earlier crises, operating at larger scale and with larger consequences. What I am watching now carries familiar fingerprints, with one critical difference. The institution that resolved 2008 is now itself the source of the stress, and that changes everything. In March 2023, Silicon Valley Bank collapsed. Within days, Signature Bank followed. Within weeks, First Republic, the 14th largest bank in the United States at the time of its failure, was seized by regulators and sold to JP Morgan in what regulators called an orderly resolution. 3 bank failures in less than 60 days, representing combined assets of over $500 billion. The official narrative, constructed quickly and maintained consistently by regulators and the financial press, was that these were idiosyncratic failures, the result of poor interest rate risk management at specific institutions with specific client concentrations in specific sectors. The message was, this is not 2008. These are not systemically important banks. The system is sound. That narrative was not fabricated. The specific details it cited were accurate. Silicon Valley Bank did have an unusual client concentration among venture-backed technology companies. It did have an unusually long-duration bond portfolio that had lost significant value as rates rose. These were genuine institutional failures in risk management. But here's what matters. The underlying cause of those failures was not idiosyncratic. It was universal. Every bank in the United States that accumulated a significant portfolio of treasury bonds and agency mortgage securities during the era of near-zero interest rates, which is to say virtually every bank in the United States, experienced meaningful mark-to-market losses when the Federal Reserve raised rates at the fastest pace in 4 decades. The unrealized losses sitting on the collective balance sheets of American commercial banks at the peak of that rate cycle reached estimates of over $600 billion. Some analyses placed the figure higher. $600 billion in unrealized losses is not a rounding error. It is a systemic condition. The banks that failed in 2023 were not the only banks with this condition. They were the banks whose specific liability structures made the condition visible first. The contagion did not spread immediately, not because the condition did not exist elsewhere, but because the Federal Reserve created the Bank Term Funding Program, the emergency lending facility established overnight on March 12, 2023, which allowed banks to borrow against their depreciated bond portfolios at par value rather than market value. This is the part most people miss. The Bank Term Funding Program did not solve the underlying problem. It papered over it. It allowed banks with impaired balance sheets to access liquidity without recognizing losses, which prevented the immediate cascade but did not eliminate the structural impairment. The losses did not disappear. They were absorbed into the Federal Reserve's own balance sheet. Transferred from the commercial banking system to the central bank through a lending mechanism that socialized the risk while deferring the day of reckoning. Let me be precise about what this means. The Federal Reserve, in order to prevent the banking system from recognizing losses caused by its own interest rate policy, created a facility that effectively subsidized those losses at the central bank level. This placed the Federal Reserve in the position of simultaneously tightening monetary policy through its rate instrument while loosening it through its emergency lending instrument. These are contradictory postures. They cannot both achieve their stated objectives. What they can do, and what they did, is buy time. Write this down. Time purchased through emergency intervention is not the same as structural stability restored. The unrealized losses have not been resolved. They have been deferred and distributed. And the Federal Reserve, which used its balance sheet to contain the 2023 episode, has less capacity to deploy the same tool again at the scale that a larger crisis would require, because its own balance sheet is already carrying the consequences of the last time it deployed that tool and the time before that. Now watch what happens next, because this is where the 2008 comparison becomes both useful and dangerously incomplete. In 2008, the crisis originated in the private sector. It originated in the balance sheets of financial institutions that had accumulated exposure to mortgage-backed securities whose underlying credit quality was far worse than their ratings suggested. The Federal Reserve and the Treasury Department, operating with enormous fiscal and monetary capacity that had not been constrained by prior crisis deployments, were able to intervene at scale, to backstop institutions, to purchase assets, to lower rates from a starting point of 5.25% down to effectively zero, and to do so from a position of relative institutional strength. The federal debt in 2008 was approximately $10 trillion. The Federal Reserve's balance sheet was under $1 trillion. The policy rate had substantial room to fall. The institutional credibility of the Fed, while tested, was not yet encumbered by years of failed inflation management and the awkward legacy of having predicted transitory inflation while presiding over the most significant inflationary episode in 4 decades. None of those conditions exist today. The federal debt is more than 3 times the 2008 level. The Federal Reserve's balance sheet, even after substantial quantitative tightening, remains more than 7 times its pre-2008 size. The policy rate, having been raised aggressively, now must choose between remaining high, which continues to stress rate-sensitive balance sheets throughout the banking system and accelerates the fiscal crisis through compounding interest costs, or being cut, which risks reigniting inflation in an economy that has not fully extinguished its inflationary psychology, and would simultaneously signal to the sovereign holders of dollar assets that the Fed has prioritized financial system support over currency discipline. That is the trap. And it is a trap that did not exist in 2008, because in 2008, the institution had the capacity to maneuver. Today, it is maneuvering inside a space that has been progressively narrowed by the consequences of every prior intervention. Here is the structural difference that makes this moment larger than 2008, not smaller, and why I want to state that with precision rather than drama. In 2008, the systemic stress was located in the private financial sector. The cure, sovereign intervention at massive scale, was available because the sovereign balance sheet was intact. The government could borrow cheaply, the central bank could expand freely, and the combination could absorb and neutralize private sector losses. Today, the stress is not located primarily in the private sector. It is located in the sovereign sector itself, in the fiscal position of the United States government, in the balance sheet of the Federal Reserve, in the structural dynamics of Treasury market demand that I have described in earlier work. When the stress is sovereign, there is no higher order balance sheet to appeal to. There is no entity that can do for the sovereign what the sovereign did for the banks in 2008. There is only the market, the collective judgment of the institutions that hold dollar assets and must continuously decide whether to hold more, hold the same, or hold less. And when the question is asked at the sovereign level, the answer that has been accumulating quietly and persistently is hold less dollars, hold more gold. The 2008 crisis was a fire in one wing of the building. The building's infrastructure, its plumbing, its structural supports, its foundations, remained intact, and that infrastructure was what allowed the fire to be contained. What we are inside now is a question about the foundations themselves, and gold, rising not in panic but in steady, sovereign, methodical accumulations, karakinde kam, irsam ki was kom ki, dede ki, momom momom, hamar kinde kan. That the foundations are less solid than they appear from the surface. If you have been searching for financial analysis that takes the underlying structural mechanics seriously, rather than reaching for the nearest dramatic comparison, subscribe now. We build this kind of thinking systematically, and there is more of it coming. Let us now turn to what gold's specific behavior in this cycle is actually communicating, because this is the thread that most directly answers the question of what comes next. Gold has, in prior episodes of financial stress, behaved according to a recognizable pattern. It rises sharply during the acute phase of a crisis, driven by fear and flight to safety buying from retail and institutional investors simultaneously. It then typically consolidates or retreats as the crisis appears to be contained and risk appetite recovers. The gold price in those episodes is primarily a fear gauge, a thermometer measuring acute systemic anxiety. That is not what is happening now. The behavior in this cycle is structurally different in two ways that matter enormously. The first difference is the identity of the buyers. In prior gold bull markets, in the 1970s and the 2000s, in the post-2008 period, the marginal buyer was primarily in the private sector. Individual investors seeking inflation protection, institutional funds adding a portfolio diversifier, speculative money rotating out of equities into hard assets. These buyers are reactive and reversible. When the crisis appears contained, they sell. When risk appetite recovers, they rotate back into equities and other assets, and the gold price retreats. The buyers in this cycle are central banks, sovereign wealth funds, reserve managers at institutions whose investment horizon is measured in decades, not quarters, and whose mandate is not to generate returns, but to preserve national wealth across political cycles and monetary regimes. These buyers do not sell when the VIX comes down. They do not rotate out of gold when equity markets recover. They have made a structural decision, a decision about the composition of their reserve portfolios over the long term, and that decision is not reversed by a Federal Reserve meeting or an improved inflation print. Over 1,000 tons of gold were purchased by central banks in 2022. The pace in 2023 approached that figure. This is not speculative positioning. It is sovereign reallocation of the deepest and most deliberate kind. And the direction of that reallocation, consistently, persistently, across more than 40 national institutions, is unambiguous. The second difference is what the gold price is rising against. In prior cycles, gold rose when the dollar weakened. The relationship was fairly direct. Dollar down, gold up. Dollar up, gold down. That inverse correlation has broken down in this cycle. Gold has risen substantially even during periods when the dollar, as measured by the DXY index against other major currencies, was not weakening. This is not a dollar story in the traditional sense. It is a story about the absolute level of trust in the dollar system, not its relative strength against other fiat currencies. Gold rising against a stable or even strengthening dollar is one of the most important signals in this entire narrative, because it means that the institutional buyers are not making a relative currency bet. They are making an absolute judgment about the nature of monetary value itself. Here is what matters. When gold rises against a strong dollar, it is not saying that the euro or the yen or the yuan is a better store of value. It is saying that all fiat currencies, all state-issued instruments whose value is contingent on the fiscal discipline and institutional credibility of their issuing governments, are being discounted simultaneously in favor of something that has no issuer, no counterparty, and no political relationship that can be compromised. That is a different kind of signal than the market has sent in any previous episode I have studied. It is not a crisis signal. It is a structural signal. It is the market's long-run judgment about a monetary architecture reaching the limits of its design tolerances. Let me be precise about the historical context for what comes next when gold sends this kind of signal. The 1970s gold market rose for precisely this reason. Not because of any single crisis, but because the monetary architecture established at Bretton Woods had been stress-tested beyond its capacity, and the market was pricing the transition to a new arrangement. Gold went from $35 per ounce, its Bretton Woods fixed price, to over $800 by 1980, not because of one event. Because of the structural repricing of what a dollar was actually worth in a world where it was no longer backed by anything except institutional credibility. Credibility that the inflation of the 1970s had severely damaged. We are not in the 1970s. The numbers are different. The mechanisms are different. The global monetary architecture is more complex. But the underlying dynamic, a monetary system that has exceeded its design tolerances being repriced by the most patient and most structurally aware capital in existence, carries the same essential fingerprint. Let us now assemble these three threads into the synthesis that makes the picture complete. The 2023 banking crisis was not resolved. It was deferred through emergency intervention that transferred systemic risk from commercial bank balance sheets to the Federal Reserve's own balance sheet, leaving the underlying structural impairment, the consequence of the fastest rate cycle in 4 decades, hitting a banking system that had extended duration aggressively during the preceding zero-rate era, intact beneath the surface. The deferral bought time. It did not restore structural soundness. The comparison to 2008 understates rather than overstates the challenge, because in 2008 the stress was private and the sovereign balance sheet was available to absorb it. Today the stress is sovereign, located in the fiscal arithmetic of an entity carrying 30+ trillion in debt, facing structurally declining demand for its primary funding instrument, and constrained in its monetary policy choices by the simultaneous requirements of inflation management, financial system stability, and fiscal sustainability that cannot all be satisfied at once. And gold, accumulating in sovereign vaults at a pace that has no precedent in half a century, rising against a strong dollar rather than a weak one, driven by institutional buyers whose time horizon and analytical depth are beyond question, is communicating a verdict that is not about any single crisis, any single data point, or any single policy decision. It is communicating a judgment about the architecture of the system itself. The common thread connecting all three is the same thread I have returned to throughout this series: the erosion of institutional credibility at the sovereign monetary level. Not the collapse of institutions, the erosion of the trust that gives those institutions their power. Trust that the Fed can control inflation without breaking the banking system. Trust that the Treasury can borrow at sustainable rates without structurally distorting the market that prices everything else. Trust that the dollar, as the world's reserve currency, will be managed with the discipline and the political neutrality that the exorbitant privilege requires. Each of those trusts is under pressure. None of them has broken entirely, but each of them is measurably less complete than it was a decade ago, and the direction of movement has been consistent. In every major monetary transition in modern history, there has been a moment, recognized only in hindsight, of course, but recognizable in the data if you know where to look, when the signal in gold shifted from tactical to structural, when the buyers changed, when the correlation broke, when the price stopped being a fear gauge and started being a verdict. That shift has a specific quality. It is quiet. It does not announce itself. It looks from the outside like just another rally, another move that will fade when the risk-on cycle resumes. And then, quarter by quarter, year by year, it does not fade. It establishes a new floor. It rises from that floor. It establishes another floor. And eventually the consensus that had been calling it a temporary move begins to recognize that it is describing something permanent. I believe that shift has already occurred. The evidence is in the identity and the persistence of the buyers. It is in the behavior of the price relative to the dollar. It is in the reserve portfolio decisions of over 40 national institutions that collectively manage more capital and operate on longer time horizons than any private market participant. The Federal Reserve signaling panic is not a phrase I use to generate alarm. Panic in institutional terms is not shouting. It is the creation of an emergency facility on a Sunday night. It is the successive interventions, each one larger and less reversible than the last. Contain the consequences of prior interventions. It is the growing gap between the institutional language of confidence and the institutional behavior of an entity that is running out of clean options. Gold sees through the language. It always has. And what it sees in this moment, priced into its sustained elevation at levels that represent the considered judgment of the world's most patient capital, is that the system is not broken yet, but that the people managing it know exactly how much pressure the foundations are under. That knowledge, acted upon with the deliberateness and scale of sovereign institutions, is why this is bigger than 2008. And it is why the price of gold is not the story. The price of gold is the evidence. The story is everything underneath it. And that story is still being written, one sovereign purchase at a time, in the quiet language of institutional conviction that speaks not in headlines, but in the composition of reserve portfolios that will define the next monetary era. The only question is whether you are reading that language, or waiting for someone else to translate it for you after the moment has passed.